inflation, bankruptcy, collapse, clash. You might be hearing all these words very often these days because things are getting pretty ugly in the global financial sector. The question is, what's wrong with the entire dollar system? We're on the edge of another global financial meltdown that could send the global economy into a deep depression. In just a few days, news starts coming out in the mainstream news media. In this video, we'll explain in 3 simple steps why we believe the next global crisis is around the corner. Step number 1. Understanding the Fed's bailout system for international banking system. Step number 2. The canary in the gold mine. And step number 3. Revealing the shocking data. Don't worry, all these steps will make sense at the end of the video. Just keep watching and remember the main words. Step number 1. Understanding the Fed's bailout system for international banking system. To indirectly bail out international banks, the U.S. Federal Reserve uses swap lines. How do these swap lines work? Well, let me explain. Here, you see the Federal Reserve on the left and the Swiss National Bank on the right side. Swiss banks are in the news, especially Credit Suisse. It's Switzerland's second largest and one of the world's heavyweights in the sector, and it's about to collapse. It's a nightmare scenario. It's almost a remake of the Lehman Brothers crash on Wall Street in 2008, which triggered the global financial crisis. Credit Suisse is a warning that more heavyweight banks are about to go bankrupt. So now coming back to our example. Both banks, the Fed and the Swiss National Bank, have their respective balance sheets. The balance sheets have assets on the left side and liabilities on the right side. For instance, if the Swiss National Bank says that for certain purposes it needs some dollars, they'll ask the Fed to swap their Swiss francs with dollars. After the swap process is done, those Swiss francs will move to the Fed's balance sheet as assets. All those dollars go to the Swiss bank's balance sheet as assets. Moreover, these francs become liabilities to the Swiss National Bank, while those dollars are liabilities on the Fed's balance sheet. But why are there liabilities on each other's balance sheets? The answer is very simple. They have bank accounts at each other's banks. Before the swap arrangement, the Swiss National Bank held weekly auctions every Wednesday to buy dollars. During these auctions, the Swiss bank didn't face any demand to acquire dollars when the economy was stable, but when there are troubled times such as the global financial crisis, the bidders begin coming to the Swiss National Bank auctions. Of course, this is because they need dollars desperately or they could face a liquidity crisis. For better understanding, let's assume the Swiss bank is holding an auction and 3 banks come to bid for dollars. These banks request the Swiss National Bank for $1 billion. The S&B will then ask the Fed for $1 billion. The Fed will give them dollars, while the Swiss National Bank gives an equal number of Swiss francs to the Fed. It'll be based on a pre-negotiated exchange rate. After the completion of the pre-decided time, they then swap back. This is like dollars going back from S&B to the Fed, while francs go from the Fed to the S&B. When they pay them at the end of the pre-decided term, they add a little interest, implying that it's not free money. The same process works for the banks who come to bid when they pay dollars back to the Swiss National Bank, and they have to do it with a certain amount of interest following a pre-decided period. This raises the question, why engage in this complex transaction? Why can't these banks just deal directly with the Fed? Well, this is because it's against the Fed's charter to bail banks directly. The Fed's doing the same thing because that's somehow now acceptable with a middleman. This is indeed a very tricky situation. Indirectly, the Fed is bailing international banks, but the Federal Reserve isn't allowed to deal with these banks directly. That's why they have to involve the Swiss National Bank. We're heading for financial trouble as the demand for the dollar by these small banks is increasing at an alarming level. Moving on to step number 2, the canary in the gold mine. Let's put it like this. Why are these international banks using the stealth bailout from the U.S. Federal Reserve? Or maybe we need to question, to what degree have these banks been using it, and what it means for the probability that we're entering a financial crisis within the next few weeks. As I mentioned earlier, weekly auctions are happening on Wednesdays, and usually no one's there to bid for the dollars. This is because they're capable of producing dollars on their own. However, It's been a while, and we're witnessing banks begging the S&B for dollars. Recently, banks are desperate to get dollars. Initially, 9 parties requested $3 billion. Well, what happened after some time? Did the situation get better, or did it get worse? The following Wednesday, the number increased to 15 parties requesting $6 billion. Since these auctions are kept anonymous, no one knows which banks these are. They could be any banks like Credit Suisse, UBS Group, Zurich Bank, or probably not. These anonymous banks are not even Swiss banks. The Swiss National Bank is a very important international hub, so possibly these banks could be from England, Germany, Japan, India, France, or more. Well, the huge demand for dollars at the Swiss National Bank indicates a huge financial meltdown globally, meaning the entire monetary system is running out of dollars. As I've told you at the start of the video, each step will make sense eventually, and now it is. So why are these banks going to the S&B and getting bailed out of the Fed? These banks won't create dollars themselves because they aren't confident that their counterparts will be stable and can honor their commitments to each other. There are chances of this activity spreading out around the globe, and this is the canary in the gold mine that's turning out to be the next global financial crisis. Step number 3, revealing the shocking data. Now let's dive into the data to determine how concerned you should be. Check out intel from the Swiss bank. The Swiss National Bank lost 142.2 billion Swiss francs, or $142.60 billion in the first 9 months of 2022. In the S&B's 155-year history, this loss is the largest. The problem is the stagflationary environment where equities lose, bonds lose, gold loses, and the Swiss franc becomes stronger. Usually, bonds and gold gain when equities lose, but that's not exactly what's happening in 2022. However, the loss could mean the central bank halts payouts to the Swiss federal and cantonal governments next year, and continued massive losses could wipe out the S&B's equities, which stood at 204 billion francs at the end of 2021. Credit Suisse is at the center of market turmoil amid rumors that the bank could be on the brink of collapse. Investors have rushed to sell Zurich-based bank shares amid concerns about its financial health as it prepares to unveil a costly restructuring plan due later this month. Credit default swaps, the type of investment that serves as insurance against a company defaulting, rose to all-time highs. Credit Suisse announced a series of radical measures last week aimed at turning around the beleaguered bank following huge third-quarter losses, including revamping its investment banking units, 9,000 job cuts, and raising fresh capital. In the first half of 2022, Credit Suisse's investment bank suffered a loss of 3.7 billion francs in 2021 and a 992 million Swiss franc loss. It was hit by the implosion of the US fund Arches, which cost Credit Suisse more than $5 billion. Meanwhile, its asset management branch was rocked by the bankruptcy of British financial firm Greensill, in which some $10 billion had been committed through 4 funds. To get an update, subscribe, like, and you must share it with your friends and family.